Support and resistance is one of the most important lessons every trader should learn. In today's video, I'll be taking you through the definitions, how to identify and draw them, and also look at some chart examples. Let's deep dive. Support and resistance levels are points where a market will experience recurring upward and downward pressures. And when they break, they tend to become the opposite obstacle, basically what you call a role reversal level. An area of support is an area that bears have to contend with because it's an area where they typically meet buying pressure. So areas of support you'll ideally see price hit and start appreciating, and area of resistance is basically the opposite of that. An area of resistance is a place where buyers will typically meet selling pressure, and typically downtrends will ideally begin from such areas. Ideally price will appreciate, hit that level, meet resistance, and ideally start retracing or change the trend completely. So let's look at the charts to see how to identify and draw them. What you see is the euro dollar weekly chart. My first step when it comes to identifying and drawing these levels, I like zooming out. And zooming out means you go to your higher time frame. You can even start off from the monthly, or you can start off from the weekly or the daily. I prefer starting off from the weekly because then I just zoom out and convert my chart to a line chart, then focus on the key swings first. What's a key swing? A key swing is an area that led to a sustained trend. As you can see, this is a key swing, led to this downtrend. So ideally I'd mark it. So I know the next time price comes to that level in future, there might be some selling pressure around that level. Look at this level. That's an area of resistance. As I said, areas where you'll typically see price meet selling pressure. As you can see, price hits those levels and starts going down. Areas of support, this is a key swing. Another area of support was here. And if you was to zoom in, looking at the most recent price behavior, you'd see an area of support around 1.05. You can see price retested, bounced, retested again and bounced. I'd see there's a level of resistance around here. I see 2 touches. Ideally, the more touches an area has, the better. And as I said, you ideally want to identify these levels starting from your high time frame. So ideally you zoom out, convert it to a line chart, mark your key swings. Once you've marked your key swings, convert it back to a candlestick chart just to adjust the levels. You ideally want to adjust the levels so that the line touches the most areas it can touch. By areas I mean the bodies, the candles, and where there's congestion of candles. Just looking at the most recent price action, you can see this is a level of resistance, and it comes in around 1.032. Ideally, if I was to zoom in, I don't like when the area I've identified cuts price, so ideally I'd adjust it upwards, or at least it touches the highest body, as you can see. As you can see, the maximum touches 1, 2, 3. I know this one doesn't touch completely, but remember, support and resistance is a zone. Ideally there are zones, and to mark your complete zone, ideally you'd put a rectangle that way. So you know anytime price hits certain areas, this level, it ideally sells off. The first touch, second touch, third touch was a false break, retested in this candle, sold off. The fourth time, sold off. So this is an area that you need to be always looking out for. Looking at the area of support, as mentioned, areas where you'd ideally meet buying pressure. I want to adjust this to at least touch the wick and this area where there's a bit of congestion of these candles. And drawing this level is more of there's a lot of discretion around it, but I'd expect most traders to come to the same conclusions in as far as the levels are concerned, and differ only on the preciseness. Yeah, so don't worry when you see some areas I put the wick, some the body. It just depends which area will give you the most touches. Yeah. To zoom out on the daily chart, you can see the levels. This one which I do on the weekly, which I see cuts prices. So sometimes these levels can be invalidated. As you can see, I had marked this swing point, but if you look at history, you'd find that this level is not being really respected right now. So ideally I'll remove it and focus on what's happening currently. If you look at this downtrend that happened in 2022 when the Fed was raising rates, there's a bit of support and resistance areas. It was to mark this area, and you can actually trade this as a strategy. Just waiting for price to break a support area and you buy on a retest, waiting it to break wait for price to break a support area and you sell on a retest, and wait for it to break a resistance area and you buy on the retest. So that's why you mark them, so that when price reaches those levels, you're able to identify a trade opportunity. So you have that area, and see how you will have traded the retest. Look at how far it went. Just taking advantage of these trades. Yeah, this one did not touch precisely, so you'll have missed out on that. But if it touched, that will have been a good trade. And you see the third trade, price broke. Look at that retest, still going down. Price broke. Say their zones may not necessarily be precise, but you can see the zone. Price retested. You can see the zones again. Price break. I put the zone, I mark it using, I look at who's the lowest body and where's the lowest wick. So I try to put it that way. Mark the zone, retested, went, and some trends end. As you can see, this trade did end, but by the time it was coming to an end, you will have made significant money just trading off the retest of these levels, because you're taking advantage of the downtrend, especially if you're a swing trader. Look at how many trade opportunities: 1, 2, 3, 4, 5, 6, and depending on how you risk, it will determine how much money you make. So when the trend reverses, it may not necessarily respect these medium term areas of support and resistance, but you'd see it ideally advance towards the next major area of support and resistance. That's why you need to mark out your major areas from the higher time frames. And you can see the same on the daily chart. What we have seen is just the weekly chart. Price is fractal, patterns of self similarity. You can see basically what you're seeing on the weekly is what you're seeing on the daily, and if you were to scale down further on the H4, you would ideally see the same thing. But the basic thing is that these are trade ideas based off support and resistance alone. Yeah, let's look at the other chart. This is the dollar yen. This is the yen pair. Just I'm zooming in into the current price action, but if you're a beginner trader, you can zoom out historical price just to help so that you can teach yourself how to identify these levels. Zoom, change into a line chart. I'd see there's a zone here. You see a swing point before it went up. There's a swing point around here. Yeah. Ideally, if I was starting to draw this, I would have put it here first. Look at that major swing point. Price came there. Then there's a swing point around here. So I'm just marking out my swing points based off what I'm seeing. Yeah, from the zoomed out picture on the weekly. If I was to turn it back to a candlestick chart, now I start adjusting. So I look at this one. I'm comfortable with the way it is. As you can see, price came here, sold, slight sell, went up, retested. As I said, support and resistance areas as zones. Always look at it as zones and not necessarily precise price levels. Yeah, and you ideally, when you're trading, like for this particular example where we're going to the upside, your best entry is at the top boundary of the zone, and your best stop loss is just below the level. Yeah, of course, your most precise entry will have been right inside the zone. It will give you a very nice R, but you stand the risk of always missing out on trades if you're that precise. Yeah. Then there's this level here. I would like to adjust it to the week. As you can see, led to this move, price retested, sold again. And this in itself is actually a trade idea. What do I mean? Once price makes a major key swing, as you see here, and it takes time to actually retrace to that level. As you can see, this level was, this high was created on 17th October. By the time we were retesting it, it's 30th October 2023. It took 1 full year to retest a level. It has taken quite a bit for price to return to this level, and shows this level is really significant because it led to a major trend. So you can actually trade this level by placing a sell limit around this area. Since there's no level above, assuming if you look to your left, there's no obstacle, you can use your ATR as your stop loss. So you do 1 ATR or 1.5 times the current ATR and put it as your stop loss, and you target the next key level that you observe in the chart. It can be a medium term swing around this zone, or you can also target a movement back to these zones. But by the time it hits and starts selling off, you'll have made quite a few pips. And as you can see, the level became a role reversal level. Once price broke this level, we did see a retest. So very aggressive, driven I think by the Japanese government intervention. I'm not sure if they admitted to it, but clearly this is some sort of intervention. And you can see it is holding. It is holding. And that is basically how you draw support and resistance levels. I don't want to go back to the euro dollar to show you that price is fractal. Whatever we've seen on the daily and the weekly actually also happens on the lower time frames. I'm now on the H4. Just taking you through a trade that I took here. As you can see, price was going down. If I was to zoom out more, where this swing, major swing, so you started going down. Then at some point, ideally, if it's in a downtrend and price is retracing to a previously broken low, you'd expect it to hold as new resistance. As you can see, it did hold around here. Yeah. But the sell-off was not aggressive as you'd expect. And price broke above. Look at the level changing its roles. Here it was support, broke, became resistance, broke again to the upside, and it became back as new support. So it is shift from resistance to now becoming support. Then you just mark out your key swings. But the ones price creates a key level or a swing, you need to mark it out and use it as a point of reference for your next trade. And as you can see, price did create this swing area, broke above, retested. There's some bullish movement of that level, retested again. The price is still holding, and the price is also now retesting it again. So there were two opportunities to actually buy that particular currency. That is if you're scalping from the lower time frames, H1, minute 15 and below. This is an area of resistance. As you can see, price has been unable to break, and you can actually trade it as a strategy. As you can see, yeah, if you just mark these areas as zones, there are trade opportunities that exist in these markets. Yeah, we break, retest, went to the next level, came back, held, break, broke back above, retested, held, broke, came back to this level. I've marked out this one. It came back. You can actually trade it as a trading strategy in itself, and it should actually form a very key component of your trading strategy. But more importantly, just as a recap, always start off from the higher time frame. Mark out your key swings as your key levels of areas, key levels of support and resistance. So key swings, where did this trend begin? I mark it as resistance. Where did this bullish begin? Mark it as support. And the day price will actually retrace to this level, you can actually buy, you can actually sell here. And within those major levels, you will still have your medium term or intermediate levels of support and resistance, which price may not necessarily respect on its way up to the next key area. Let me look at a chart like gold that was it had been ranging for a while. Yeah, as you can see, to put it in a line chart, we have a swing point around here. We have this swing led to this move, this swing led to this move, this swing led to this move. Remember, a line chart is formed by the bodies of the candle. So that's why you see when I turn it into a candlestick, I'll have to adjust again, because a line chart will ideally reach here as a swing point where this body is, yeah, where the bodies are. That's why you see when I adjust, sometimes I have to move my levels up or down depending on how the chart looks like, as long as it gives me a number of touches. The first touch led to a swing point. Look at how long it took to retrace to that level. When it touches it again, remember I said it's a zone, it will not necessarily be a precise line. Sold. So 3 touches. Usually the first retest to that swing point is a good sell. See, the third one did not lead to a major move downward because the market was heavily bullish. But if you're trading the lower time frames, you'd ideally find trading opportunities. And assuming it works out 70% of the time, when you're making money 70% of the time off one strategy, just trading the support and resistant areas, I mean, you're good. You're good to go. As you can see, the intermediate levels within the chart, we had this level, it broke, price retested, went down, it broke back above, look at how price respects these levels, especially if they form on a higher time frame. And right now, you can see it had formed. It was to scale down to the daily just to show you that level of resistance. Sold, it's coming now to an area of support. And that, ladies and gentlemen, is how you draw support and resistance levels. I hope the video has been useful. Please subscribe to the channel and hit the notification bell so that you don't miss out whenever I upload. Thank you.